error on the horizon, or that the Fed chair doesn't know what he's talking about, that inflation is going to be more persistent and last for much longer than he thinks. But in fact, it's not. And you alluded to this earlier. The bond market itself is giving the Fed chair the benefit right now.
Yeah. And by the way, Scott, I prepared a Fed probability chart. I don't know if they have it in the back there, but the market's given the Fed a lot of leeway on rates. You know, if you look at the probabilities, you're a year out till you get the 50% probability of the first quarter point rate hike in the fall of 2022. That really is extraordinary freedom from the markets. And look, you're right, Scott. There's three pillars here of Fed policy that you want to look at. The first is the data. The Fed thinks the data is mixed. You have high inflation, but you have the labor market underperforming. The second one is the market. The market is giving the Fed leeway to promulgate these policies. And the third one we're going to get in a few minutes is the political backdrop. The Fed does not make policy in a vacuum. So we'll see how much pressure the Federal Reserve Chair gets when it comes to inflation and the Fed's policy.
I should also let all of you know a reminder that tomorrow we're going to be speaking exclusively with Double Line CEO Jeffrey Gundlach, who you know is going to have reaction to what the Fed is doing, what the chairman himself is saying today, and just where we are in the market. Remember, it was at the very beginning of the year when Mr. Gundlach was last with us and suggested that the market was trading at exceptionally high valuation. S&P's up 15% since then. So you can only wonder what he might be thinking now and what his reaction to Jay Powell will be. Here's the Fed chair.
Monetary policy report. At the Fed, we're strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. We pursue these goals based solely on data and objective analysis, and we are committed to doing so in a clear and transparent manner. Today, I will review the current economic situation before turning to monetary policy. Over the first half of 2021, ongoing vaccinations have led to a reopening of the economy and strong economic growth, supported by accommodative monetary and fiscal policy. Real gross domestic product this year appears to be on track to post its fastest increase in decades. Household spending is rising at an especially rapid pace, boosted by strong fiscal support, accommodative financial conditions, and the reopening of the economy. Housing demand remains very strong, and overall business investment is increasing at a solid pace. As described in our monetary policy report, supply constraints have been restraining activity in some industries, most notably in the motor vehicle industry, where the worldwide shortage of semiconductors has sharply curtailed production so far this year. Conditions in the labor market have continued to improve, but there is still a long way to go. Labor demand appears to be very strong. Job openings are at a record high, hiring is robust, and many workers are leaving their current jobs to search for better ones. Indeed, employers added 1.7 million workers from April through June. However, the unemployment rate remained elevated in June at 5.9%, and this figure understates the shortfall in employment, particularly as participation in the labor market has not moved up from the low rates that have prevailed for most of the last year. Job gains should be strong in coming months as public health conditions continue to improve and as some of the other pandemic-related factors currently weighing them down diminish. As discussed in the monetary policy report, the pandemic-induced declines in employment last year were largest for workers with lower wages and for African Americans and Hispanics. Despite substantial improvements for all racial and ethnic groups, the hardest hit groups still have the most ground left to regain. Inflation has increased notably and will likely remain elevated in coming months before moderating. Inflation is being temporarily boosted by base effects as the sharp pandemic-related price increases from last spring drop out of the 12-month calculation. In addition, strong demand in sectors where production bottlenecks or other supply constraints have limited production has led to especially rapid price increases for some goods and services, which should partially reverse as the effects of the bottlenecks unwind. Prices for services that were hard hit by the pandemic have also jumped in recent months as demand for these services has surged with the reopening of the economy. To avoid sustained periods of unusually low or high inflation, the FOMC monetary policy framework seeks longer-term inflation expectations that are well anchored at 2%, the committee's longer-run inflation objective. Measures of longer-term inflation expectations have moved up from their pandemic lows and are in a range that is broadly consistent with the FOMC's longer-run inflation goal. Two boxes in the July Monetary Policy Report discuss recent developments in inflation and inflation expectations. Sustainably achieving maximum employment and price stability depends on a stable financial system, and we continue to monitor vulnerabilities here. While asset valuations have generally risen with improving fundamentals as well as increased investor risk appetite, household balance sheets are on average quite strong. Business leverage has been declining from high levels, and the institutions at the core of the financial system remain resilient. Turning to monetary policy, at our June meeting, the FOMC kept the federal funds rate near zero and maintained the pace of our asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. We continue to expect that it will be appropriate to maintain the current target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. As the committee reiterated in our June policy statement, with inflation having run persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. As always, in assessing the appropriate stance of policy, we will continue to monitor the implications of incoming information for the economic outlook and would be prepared to adjust the stance of monetary policy as appropriate if we saw signs that the path of inflation or longer-term inflation expectations were moving materially and persistently beyond levels consistent with our goal. In addition, we're continuing to increase our holdings of Treasury securities and agency MBS, at least at their current pace, until substantial further progress has been made toward our maximum employment and price stability goals. These purchases have materially eased financial conditions and are providing substantial support for the economy. At our June meeting, the committee discussed the economy's progress toward our goals since we adopted our asset purchase guidance last December. While reaching the standard of substantial further progress is still a ways off, participants expect that progress will continue, and we will continue these discussions in coming meetings. As we've said, we'll provide advance notice before announcing any decision to make changes to our purchases. To wrap up, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. The resumption of our Fed Listens initiative will further strengthen our ongoing efforts to learn from a broad range of groups about how they are recovering from the economic hardships brought on by the pandemic. We at the Federal Reserve will do everything we can to support the recovery and foster progress toward our goals of maximum employment and stable prices. Thank you. I will look forward to our discussion.
Thank you very much, Chairman Powell. And I'd like to clarify that the end time for this hearing is 3 o'clock Pacific time and 12 p.m. Eastern time. So thank you very much. And at this time, I would now like to recognize myself for 5 minutes for questions. Chair Powell, I want to understand some of the data behind the recent inflation figures, specifically as it relates to housing and home prices. According to the Monetary Policy Report we are discussing today, quote, new construction, home sales, and residential improvements have all been well above pre-pandemic levels, and demand has outpaced supply as construction has been limited by material shortages and sales have been constrained by low inventories, unquote. So demand for housing clearly outweighs the supply of housing. Chair Powell, you said that this is a problem for first-time home buyers for sure. Can you elaborate on what you meant by that? Chair Powell, will you unmute?
I'm sorry, Madam Chair. So housing prices are moving up across the country at a high rate. And I suppose the good news is that this is not driven by the kind of reckless, irresponsible lending that led to the housing bubble, that led to the last financial crisis. Those kinds of things are not happening, at least so far. Nonetheless, housing prices are moving up, and of course that makes it more difficult for entry-level buyers to get into the housing market. So that is a concern. I will also point out, though, that a number of things are driving up housing prices. Certainly, low rates are part of that. There are also changes in preference. People have wanted to move out of cities because of COVID into surrounding areas, so single-family housing demand has been quite high. In addition, prices have been driven up by material shortages and things like that, which we would hope would be alleviated.
Okay, so Chairman Powell, a lack of supply and constraints around housing stock are a factor in the recent increase in housing costs. If the Fed were to raise interest rates, what do you project the impact would be on addressing housing supply challenges?
Well, it wouldn't have any effect on the supply side, as I think you're suggesting. There are limitations around the availability of some raw materials and of labor and of zoning and things like that, and nothing we can do can really affect that. It is true that interest rates are one factor that's supporting demand, but we really can't do much about the supply side.
Conversely, do you expect that increasing housing supply would help alleviate inflation?
I think housing, sure. I do think that more housing supply, if demand were to remain constant, would certainly imply that prices would stop going up as much as they have been.
The Great Recession was long, slow, and inequitable, in part because fiscal support provided by Congress was insufficient. And we left too much up to the Fed to stimulate the economy through low interest rates. I believe strongly that we cannot repeat that mistake. And as I look around at what is causing surging prices, I see a lot of places where more investment will help with long-term economic growth, especially more housing. Congress and the Biden administration have a job to do right now. It is for this reason I'm reintroducing my Housing is Infrastructure Act this week to ensure that Congress finally makes long overdue investments in the housing market. This bill would provide a historic investment of more than $600 billion to ensure that affordable housing is available all across the country. And so, as you know, I'm focused very much on housing, and I understand that there's a great need for affordable housing. As you know, homelessness is just increasing all over this country, and some cities have given up on even trying to control the camps that are popping up on sidewalks and under bridges. And so how important do you think investment in housing is to this economy?
Well, the housing industry is a big one, and the problem of affordable housing is a big one too, albeit it's one largely outside of the ambit of the Fed's responsibilities, but certainly a very important issue. And I think as you point out, the rise in homelessness in the face of a very strong recovery is actually evidence of the unevenness of the recovery. So, which is something we try to keep in mind as well.
Well, thank you very much. I now call on the ranking member for 5 minutes for questions.
Chair Powell.
Mr. McHenry.
Chair Powell, thank you for being back. We have a lot of debate about monetary policy, but fiscal policy is also an important discussion. Chair Powell, when Congress, and I recognize, Chair Powell, you have say over monetary policy, but not fiscal policy. This is the responsibility of Congress. But Chair Powell, when Congress enacts new spending, does the Fed incorporate that new spending into its economic projections?
Yes, we do. Of course, we don't, as you know, we don't comment on or try in any way to play a role in fiscal policy, in particular fiscal policies. But yes, we take it as an external factor that we would factor into our models and into our assessment of the economy.
Okay, so that spending impacts the course of Fed's decision making, and the Fed will follow, in essence, right? You have no say over it, but you will incorporate that into your decision making. Will adding another $4.5 trillion in new spending impact the Fed's decision making?
So I should be clear, it's one of many factors that we consider. And, so our focus is on maximum employment and price stability. So we would tend to look. One thing would be you would want to know how much of it's paid for and that kind of thing. But sort of the net deficit spending would enter into anybody's projections really of the economy and ultimately into projections of the labor market and of inflation over time. It's hard to say exactly how without knowing a lot of the details, because it also depends. It matters what money is spent on and over what period of time, that sort of thing.
Sure. So the spend rate matters, but fiscal policy, both tax and spend policy, impacts the Fed's decision making. So for those in Congress that are saying that irresponsible spending won't impact the Fed's decision making and won't impact our economy long term, it certainly is not in keeping with how these decisions are made. So I want to switch subjects a little bit. Chair Powell, as you know, there's been a great interest in central bank digital currencies. Many countries, like China in particular, are focused on establishing a CBDC. You indicated this earlier this year that the Fed would study and issue a white paper on the subject. What is the status of that report?
We expect to publish a report around, could be early September or plus or minus, right in that time frame. And the status of it is we're working hard on it right now. But let me tell you what it is really. We're going to address digital payments broadly. So that means stable coins, it means crypto assets, it means a CBDC. That whole group of issues and payment mechanisms, which we think are really at a critical point in terms of the appropriate regulation, and in the case of a CBDC, a central bank digital currency, laying out really questions for the public to respond to about what good it can do, what the costs and benefits of it would be. We want to begin really a major public consultation across many different groups, including Congress, of course, on a CBDC and also on stable coins and crypto.
But so there are certainly advantages to a central bank digital currency or a faster payment system. But there are certainly risks. That's the case, right? This is not a riskless proposition. It's a pretty bold proposition for the Federal Reserve, is it not?
Yes, and we'll lay out the possible potential benefits. We'll put those out on paper, and also, the potential risks that are undertaken. And I think those have been written up in many forums around the world, and I think both are real. And it really depends. A lot depends on the U.S. institutional context and on why we would need a central bank digital currency and how you weigh those costs and benefits. So that's really the nature of the exercise.
And so stable coins certainly have some advantages in terms of a faster payment system and have some of the attributes of CBDC. But there are some risks with stable coins right now. Are there not? Are there concerns you have about stable coins?
Yeah, I think the issue, stable coins are a lot like money market funds or bank deposits or a narrow bank, depending on the terms of them, that kind of thing, but without the regulation. And I think we have a tradition in this country where the public's money is held in what is supposed to be a very safe asset. We have a pretty strong regulatory framework around bank deposits, for example, or money market funds. That doesn't exist really for stablecoins. And if they're going to be a significant part of the payments universe, which we don't think crypto assets will be, but stablecoins might be, then we need an appropriate regulatory framework, which frankly we don't have.
Thank you.
Thank you very much. Clarification. This hearing will end 3 p.m. Eastern time. 12 p.m. Pacific time. Why didn't somebody say something?
Well, it's a relief for all of us.
I'm relieved.
Okay.
Well, yeah, we don't like interrupting our chairwoman. That's why we knew you would figure it out.
Excuse me, the gentlewoman from New York. Thank you, Ms. Maloney, who is also the chair of the House Committee on Oversight and Reform, is now recognized for 5 minutes.
Well, thank you for that correction.
You're
Chair
welcome.
Chair Powell, it's very good to see you again. Last month, when you testified before the Select Subcommittee on Coronavirus and the Crisis, you and I discussed the current economic recovery, and I expressed concern, along with other members, about prematurely cutting off this recovery by raising interest rates too soon. I want to touch on a related topic today, and that's the Fed's asset purchases. As you know, the Fed is currently supporting the economy by purchasing $120 billion a month in treasuries and mortgage securities, and the Fed has said that it will continue these purchases until, quote, substantial further progress has been made toward the committee's maximum employment and price stability goals, end quote. The minutes from last month's Fed's meeting stated that the Fed is continuing its asset purchases because participants generally did not believe that the goal of, quote, substantial further progress has been made yet. And I agree. I think it's far too early for the Fed to start tapering its asset purchases and pulling back on its support for the economy. So, Chairman Powell, would you please elaborate on what you believe, quote, substantial further progress, end quote, looks like? What do you need to see happen before you will support tapering the Fed's asset purchases?
So, we'll know. I would say this: we didn't try to write down a particular set of numbers that would capture what we mean by that, and it would have been complicated and not particularly worthwhile. So we thought. So we said substantial further progress, which is similar to what we did during the recovery of the global financial crisis years ago. We had a similar kind of set of words for when we would taper asset purchases. So the thing is, it's very difficult to be precise about it because with maximum employment, there are no 3 or 4 or 5 or 6 metrics that you could point to. It really is a very broad range of things, including wages, unemployment, levels of employment, participation, all those things. So we just said substantial further progress, and we also said that we would provide advance notice, well in advance of actually tapering, so that understanding that this is somewhat of a discretionary test, and that we don't want to surprise markets or the public. So we will provide lots of notice as we go forward on that. And by the way, we have another FOMC meeting in a couple of weeks from today, and we'll have another round of discussions on this very topic.
Great, thank you. Chair Powell, in May, President Biden took action through an executive order to address the serious threat that the climate crisis poses to our economy. And we are seeing numerous examples of that changing climate and extreme weather events that result from this threat. We saw extreme heat across the Pacific Northwest, which will have cascading effects on the U.S. economy. And part of that executive order was tasking Secretary Yellen with assessing climate-related financial risks through FSOC, of which the Fed is a member. And I know the Fed presented on climate risk during the first FSOC meeting of this year. Can you provide us with an update on the Fed's current work with FSOC on this topic and the Fed's broader work to address climate change in our financial system, particularly at these risks, how these risks can impact our broader economy through supply chain disruptions or disruptions to massive industries such as agriculture?
Sure, I'd be glad to. So the Fed's work on climate change really exists as part of our pre-existing mandates for supervising financial institutions and for the overall stability of the financial system. So as far as individual financial institutions are concerned, as supervisors, we want them to be aware of and capable of managing and understanding all of the risks that they run, including the risks to their business activities and business model from climate change. So we're in the beginning stages of working up a program that will engage with the financial institutions and make sure that happens. On financial system more broadly, we have an overlapping effort that looks carefully at the broader financial system and asks how will climate change affect financial markets and other financial institutions that are not banks, for example, insurance companies and many others like that, asset managers. And so those are really two efforts that we're working on, and that's what we reported on to the FSOC.
Time has expired. Thank you very much. I yield back. Thank you.
The gentlewoman from Missouri, Ms. Wagner, is now recognized for 5 minutes.
I thank you, Madam Chairwoman, and Chairman Powell, thank you for being here with us again today. You and I have discussed at length my very grave concerns with higher inflation and the increased costs that consumers and businesses are experiencing today. In February, you appeared before this committee and reiterated that the price spikes are only temporary and that they will decrease in time and inflation will move towards your goal of 2%. I can tell you that the families and businesses that I represent in Missouri's 2nd Congressional District aren't feeling that these price spikes are very temporary. I am concerned with the most recent Consumer Price Index data showing price increases that are much higher than expectations. Housing costs are, as we've discussed here, are skyrocketing. Food costs are higher. Electricity and gas prices are up. Even travel and hospitality costs have seen a great increase. I understand that some of these increases are due to supply chain disruptions and labor shortages, but to have prices across the board consistently higher than they were forecasted to be is deeply troubling as we look toward a strong economic growth for the rest of the year and beyond as we pull out of this pandemic. Chairman Powell, is it the Fed's policy or the Biden administration's policy that is, that's surrounded with massive spending that is causing consumer prices to skyrocket?
I can't really address that. I can tell you why I think we're having this inflation that we're having now. So what's really happening is, first of all, you're right. The incoming inflation data have been higher than expected and hoped for, but they're actually still consistent with what we've been talking about. The very high inflation readings are coming from a small group of goods and services that are directly tied to the reopening of the economy. It's new cars, used cars, rental cars, hotel rooms, airplane tickets, things that we understand how to connect. But
with all due respect, Chairman Powell, I mean, it's housing, it's appliances, it's food prices, it's electricity, it's gas. Tell me, to what extent is the Federal Reserve willing to see consumer prices increase before intervention is necessary?
Well, so we are monitoring the situation very carefully, and we are committed to price stability. And if we were to see that inflation were remaining high and remaining materially higher above our target for a period of time, and that it was threatening to uproot inflation expectations and create a risk of a longer period of inflation, then we would absolutely change our policy as appropriate.
Well, unemployment is still well above the 3.5% figure it reached prior to the pandemic, and the labor force participation rate remains lower than in February of 2020. Now, a lot of that is because the administration is still, frankly, paying people not to work, and while job openings remain high at 9.2 million. In the FOMC minutes from June, some participants believed that the unemployment rate of 3.5% that the previous administration achieved is not feasible. Chairman Powell, with 9.2 million job openings and many employers raising wages and offering hiring bonuses, etc., what is causing some members of the FOMC to believe a 3.5% unemployment rate is not achievable?
I don't know that anyone said that. I didn't hear anyone say that 3.5% unemployment is...
It's in the minutes. It's in the minutes from June.
No, it's not. It must be something else. It must be something that says... you might say that about labor force participation, for example, or employment to population. But I don't think... I didn't hear anybody say that we couldn't get back to 3.5% unemployment. In any case, I don't believe that. Let me just say that. I don't believe that. I think it's a long road back. It took us it took us 8 years of an expansion to get to 3.5%. But I think there's every reason to think that we can get back to that level.
With a vaccine readily available in small businesses with unfilled positions, what do you believe is causing the unemployment rate to remain steadily above 3.5%?
Well, so I think you're right that the demand for labor is very, very high, all-time record job openings, and there are also significant numbers of unemployed people. The market doesn't seem to clear, and I think some factors are weighing on labor supply, people going back to work. We think that those factors, though, such as school reopenings and perhaps also unemployment insurance, we think that those things will pass, and we do think that as a result there'll be very strong job creation.
Thank you, Chairman Powell. My time's expired and I yield back.
The gentleman from New York, Mr. Meeks, who is also the chair of the House Committee on Foreign Affairs, is now recognized for 5 minutes.
Thank you, Madam Speaker, and welcome back, Chairman Powell. Now, as you know, the Biden administration recently issued an executive order promoting competition in the American economy and encouraging the Attorney General, in consultation with the primary federal banking agencies, to update existing guidelines on bank mergers, provide more robust scrutiny on these transactions. And I support this executive order, considering the impact that bank consolidation can have on communities of color. Now, compliance with the Community Reinvestment Act is an important measure that the DOJ and the feds consider during the bank merger review process. And as you know, I've publicly supported the Fed's direction in modernizing CRA regulations so that things like the bank merger review process can adequately reflect the economic needs of today. So can you please explain how the Fed plans to coordinate with the DOJ in light of the bank merger executive order? And will the Fed's CRA reform efforts and the DOJ's bank merger updates happen in silos or in tandem?
Thank you. So we actually we coordinate pretty closely with the Department of Justice over the years on bank antitrust standards. We each look at each merger, and so we understand each other. And we would look forward to the extent justice, I think, under the executive order, is encouraged to take a fresh look at bank merger standards. We would, of course, closely coordinate and try to understand what's going on. We haven't made any decision to change our merger standards, but we would certainly monitor that carefully and act appropriately. I can't presume to know what will happen out of this, but it's a process that we'll go through in coordination with justice.
Well, hopefully, the coordination is important, I believe, to act in tandem so that there's not several different CRA rules and regulations that comes out, as we've talked about with the OCC and others. So I appreciate the Fed making sure that there's some continuity in that regard and working in tandem. So also, the pandemic has really disrupted, I believe, the housing market, as it was indicated by the chairwoman. I look at the disproportionate number of homeowners, particularly in my district, of Black and brown homeowners relative to New York City at large. Now, in the pandemic's early days, the Fed rightfully intervened and purchased mortgage-backed securities in the billions, which helped keep the interest rates low, I understand. However, we've also experienced a rise now in housing prices.
And in supply reasons, and you touched on them, Congressman. On the supply side, it is prices of raw materials and lack of labor, labor costs, zoning difficulties, all those things. So it's not just a demand story. On the demand side, rates are definitely low. Interest rates are certainly making mortgages cheaper, and therefore supporting prices in housing. That's certainly a factor. There are other factors too. Changing preferences. People household balance sheets are very strong right now because people were kind of forced to save because they couldn't go on trips, they couldn't go to restaurants for a year. So there are big amounts of savings on people's balance sheets. So all of that goes into demand for housing. Sorry, then your question on that was what?
So what are some of the economic factors that you are considering, in that argument? There's both.
On mortgage-backed securities. So on mortgage-backed securities in particular, so interest rates, our low interest rates and Treasury purchases and MBS all go into creating a low interest rate environment and go into mortgage rates. Mortgage-backed securities purchases really work a lot like Treasury purchases. They aren't especially important in what's happening with housing prices. they are nonetheless, they clearly are a factor among factors. So this is one of the things that we'll be considering as we go through this process of evaluating when to taper and in what form, what will be the composition of asset purchases going forward. Those are all issues that we'll be discussing at this next meeting in a couple of weeks.
Thank you, Mike. Goodbye.
Thank you very much. The gentleman from Indiana, Mr. Hollingsworth, is now recognized for 5 minutes.
Well, good afternoon, Chairman Powell. Appreciate you being here and certainly appreciate you answering our questions. I know this remains a tricky time in the recovery, and our collective understanding about the Fed's effort and reasoning here is very important. I have a long preamble that I hope ends in a question, so take a little bit of a journey with me. First and foremost, I want you to know I'm in no way besmirching the good work the Fed has done over the last year. The extraordinary economic cessation necessitated extreme action, and you took that action with vigor. I'm thankful for that, and my view on that is unchanged. Second, my question is not meant to imply that you need a hawkish stance. I think we can all agree that monetary policy is very accommodative at present, perhaps at the furthest end of the accommodative side of the spectrum as is conceivable. I'm questioning merely the degree of accommodative stance, not asking to return to a restrictive side of the spectrum. Third, I have on many occasions endorsed your new symmetrical approach to inflation target. I believe this is exactly the right answer. My question today is not tied to recent inflation numbers, nor would I prognosticate about whether it's transitory or not, whether it's a monetary phenomenon, a demand phenomenon, nor the magnitude of what it may reach. But here's the crux of my question. I think there's a lot of data out in the economy showing that it is awash in liquidity. A panoply of statistics indicate the tremendous / unprecedented increase in liquidity over recent years. In recent weeks alone, you've raised the reverse repo rate to 0.05%, and the uptake on that product has been tremendous, which in and of itself is a reaction to money markets being overwhelmed with liquidity, which in and of itself is a reaction to bank deposits being overwhelmed. Yet the ultra accommodative stance by the Fed continues. And when asked about this over the last few months, and I think you indicated this in your earlier testimony, I've heard you say that there needs necessary further healing in the labor market for that ultra accommodative stance to change. I agree with this. There's much room to go. But what I don't understand about that answer is that a cornucopia of evidence suggests that challenges in the labor market are not related to monetary policy and frankly aren't susceptible to monetary policy's aid. The Fed, and no indictment on the Fed, monetary policy writ large isn't the right vehicle and doesn't have the right tools to resolve skills mismatch, to resolve no work incentive balancing, and to resolve geographic mismatch. As you said earlier, there isn't a lack of demand in the jobs market. So I guess getting to the specifics of my question, I believe the Fed is distorting significantly the financial economy for very little, if any, maybe marginal impact on the real economy. To couch specifically inside your mandate, are you jeopardizing long-term full employment and price stability by virtue of extreme monetary policy and picking up very little short-term benefit in full employment? I wondered if you might talk about your reasoning and your colleagues' reasoning for remaining and retaining that extreme accommodative stance and using labor market as justification, despite significant evidence indicating that the labor market needs are not monetary policy related. I think you're muted. Sorry.
I did it again. I would just say this. So policy is highly accommodative. That is correct. We're a long way from full employment. We have, as you know, 5.9% unemployment, and the true number is actually substantially above that. So we've got a ways to go. We see everything that you see, but I guess what we see is that our test for tapering asset purchases is an appropriate one, and we're making progress toward that. So we are, in fact, considering.
I guess just to needle into that for a second, we are making progress. I do not believe that progress is a result of that monthly asset purchases. And I think I've seen significant evidence that indicates that monetary policy isn't making an impact on that. Other factors are making an impact on that. And I wonder whether the financial distortion that is occurring, and is it by its nature monetary policy, isn't causing long-term problems for very little short-term gain.
Yeah, no, I guess that's where I would differ is I do think monetary policy is supporting demand and demand broadly in the economy and the recovery of the weak sectors and all of that. So it's still appropriate that monetary policy be accommodative, highly accommodative.
you believe that the difference between 60 billion and 120 billion, or 0 billion versus 120 billion, is a material impact on the point at which we will reach full employment? Question mark.
I mean, it's hard to say that with any specificity, but yes, I think our overall policy stance is appropriate. And as you know, we are very much in the process of walking down the road and asking those very questions. And first on tapering, but I also think it's, we're a good ways away from maximum employment. And one of the conditions for lifting interest rates is that we are at labor market conditions that are comparable, in the range of maximum employment.
Thank you very much. The gentleman's time has expired. The gentleman from Massachusetts, Mr. Lynch, is now recognized for 5 minutes. Mr. Lynch?
Can you hear me?
Now I can.
Okay. Thank you, Madam Chair. And Chairman Powell, thank you so much for your willingness to help the committee with its work. So I was very pleased to hear in your opening remarks that the Fed plans an open dialogue with the public and with stakeholders regarding CBDCs as well as cryptocurrency generally, and I think that's much needed. And I'm very proud of the fact that the Boston Fed, under the leadership of Eric Rosengren, has been working with MIT in their cryptocurrency lab on working on this digital dollar for the United States and for the Fed. I am a little bit worried about the pace, though. We see, I think there's 86 separate central banks that are already engaged in this. Do we risk sacrificing the primacy and the reserve currency status by I think some would argue slowness in response to this? And does this dialogue that you envision stretch out the timeline for adopting, say, a digital dollar for the U.S.? Does it delay that considerably?
I would agree. No, actually, I think the opposite. I think this is the beginning of we think accelerating that decision process. We have a lot of work left to do on the technical side and on the policy side, but a critical part of it is just the public consultation. But on reserve currency, the U.S. is the reserve currency. There really isn't a good competitor out there, because all the things you need to be the reserve currency, really, the United States has it. We're not in danger of losing it. Certainly not to China, which doesn't have an open capital account, that kind of thing. It's the kind of status that, as you well know, lasts for many, many years. So I'm not concerned about
that. Fair enough. Let me ask you another question that's a little off topic, but recently China has taken somewhat hostile action against IPOs being launched in the United States. Didi, the ride-hailing business in China, is one of the recent examples. The Chinese government has offered several different reasons for wanting these Chinese companies to register in China versus in the U.S. They've given, like I say, they've given various reasons for that, the security of data being one of them. I was wondering if you had, this is probably a better question for Mr. Gensler, but I was wondering if you had thoughts on that, about what the ultimate reasons were for China taking that action.
Yeah, I would pass that to my friend Gary Gensler. I think it's right over his home plate there. So for him, I mean, I'll just say it's important that we have, open capital accounts and open capital markets and global rules that we all abide by. And but I don't know how to address that one, because it's really for the SEC.
Okay, and lastly, do you think that I have 1 minute left? Do you think that maybe more swift action on a digital currency for the Fed, would that have a calming effect on the variety and the number of cryptocurrencies and stable coins that we see coming out, wouldn't that be a more viable and reliable alternative than having all of these hundreds and perhaps 1,000 different cryptocurrencies emerging?
I think that may be the case, and I think that's one of the arguments that are offered in favor of a digital currency. That particularly you wouldn't need stable coins, you wouldn't need cryptocurrencies if you had a digital U.S. currency. I think that's one of the stronger arguments in its favor.
That's great. Madam Chair, I yield back. Thank you.
Thank you very much. The gentleman from Ohio, Mr. Gonzalez, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Powell. I want to pick up where my friend Mr. Hollingsworth left off and want to focus specifically on the unemployment piece. And frankly, when I talk to my businesses back home, where I'm currently seated, the two biggest issues that they face, in particular small businesses, employment, not being able to get people back to work, and inflation. So a timely hearing right in your wheelhouse. So first, with respect to unemployment, in the monetary policy report, you cite several factors that are keeping people out of the workforce, most of which, or all of them, are virus related. So early retirements, caregiving responsibilities, fear of COVID, and expanded unemployment benefits. Using those factors, which you cited in the monetary policy report as responsible for diminished employment, would you agree that the zero interest rate posture is not a primary driver of getting people back into the workforce today? And maybe said differently, do you think if you lowered us to negative interest rates that would materially change the unemployment rate?
Let me try to answer that this way. I would agree with you that the most important thing, it would be very important if we were to see a significant increase, as we expect we will see, in labor supply. It just showing up in the form of better matching in the labor market. There are all these open jobs, and there are many unemployed people, but they just don't seem to be matching up. And maybe there's a speed limit on that. But in any case, as those factors wane, we should see more of that, and that's probably of first order importance at this time.
Okay, so not the rate of interest, and I think that's important because the commitment is to keep rates at zero until we get back to full employment, but we know what's happening is it's inflating asset bubbles. It's pushing people further and further out on the risk curve. I would argue it's creating systemic risk in a variety of markets. And so I would just encourage you all to consider that. And now moving on to the inflation bit, the common refrain from the Fed has been that inflation is transitory. There's nothing to worry about. And you will maintain rates at zero until inflation is moderately above 2% for, quote, some time. And you've said that a handful of times here. Well, we're looking at 4 consecutive months now, including the previous month at over 5%. So how long is, quote, some time? And what factors are you looking at that will tell you whether this is transitory or something more systemic?
Okay, let me say first on maximum employment, even after this expected wave of supply comes, it's likely that we'll still be short of maximum employment. And at that time, support for demand will be appropriate. And so that's why we wouldn't see that it's time to raise interest rates now, because we think it'll take some time even after this to get there. So getting to your inflation question.
Which is basically how long is some time? Because it keeps being used. We'll keep it over some time.
So that will be... the answer really is it depends. You're really asking about that part of the guidance and how do we think about that. Right now, of course, inflation is not moderately above 2%. It's well above 2%. And it's nothing like moderately. So the question will be, and this will be a question for the committee, how to interpret the guidance. The question will be, where does this leave us in 6 months or so when inflation, as we expect, does move down? How will that part of the guidance work? And it will depend on the path of the economy. It really will. It may be that we'll look back and see this having been met. It may be that we won't, but we're not going to address that right now. But it's a good question.
Okay, thank you. I want to switch to stable coins and pick up where Mr. McHenry left off, specifically on Tether. So in recent months, there's been increased scrutiny of the stablecoin Tether due to concerns regarding the assets backing the coin. particularly the amount backed by commercial paper as opposed to U.S. dollars, which is what they originally said. President Rosengren said that Tether does create a challenge and that we need to take seriously what happens when people run from these instruments very quickly. Do you share these concerns, and how, is that the sort of thing that you'll be looking at and providing guidance on with the white paper?
Yes, absolutely. Yes. I mean, commercial paper, are short-term overnight obligations of companies, and most of the time they're investment grade. Most of the time they're very liquid. It's all good. But in both of the last two financial, during the acute phase of the crisis, the market just disappears, and that's when people will want their money. So, it's very simple. These are economic activities that are very similar to bank deposits and money market funds, and they need to be regulated in comparable ways. That's how I see it.
Thank you. The gentleman's time has expired. The gentleman from New Jersey, Mr. Gottheimer, is now recognized for 5 minutes.
Thank you, Chairman Waters, and it's definitely Jersey.
Yes.
And thank you, Chairman Powell, for being here today. The SALT deduction cap jammed through Congress in the 2017 tax hike bill raised taxes for a majority of the families in my district. These are my community's teachers and first responders, small business owners, young people trying to start a family, all groups who are struggling in this pandemic and now trying to get back on their feet. When you were before this committee earlier this year with Treasury Secretary Yellen, the Secretary said that the SALT cap led to disparate treatment, quote, and that she would work with me to ensure that the inequities caused by the cap would be remedied. Chairman Powell, is increasing disposable income for households a crucial tool to stimulate the economy and ensure that our communities see the economic activity necessary to help small businesses come back from the pandemic? And do you think SALT's part of that solution, reinstating the SALT deduction?
So, we have really important jobs and powerful tools, but one of them is not fiscal policy. We don't really want to play a role on that. So I'd have to leave that with you.
Okay, well, I figured that'd be your answer, but I was going to ask it anyway. I'll turn to inflation, since obviously lots of questions today about that. Given the movements we are seeing in inflation across commodities, housing, and wages, should we be concerned about what happens to long-term interest rates once the Fed stops purchasing long-dated treasuries? And do you want long rates go up, and what will happen, do you believe, to the economy?
I wouldn't want to make a forecast. It's very hard to forecast long-term rates. If anybody had forecasted that we'd be able to borrow the amounts we've borrowed in the last 10 years, and that the federal funds rate would be at the 10-year Treasury would be at 1.4%. No one would have forecast that. So it's really hard to say. There's tremendous demand for U.S. Treasuries around the world. We are the safe asset. We are the reserve currency. And in any case, our role is to do maximum employment and price stability, and not fiscal policy.
Since the Fed is by far the largest buyer, you don't think that long-term rates will go up meaningfully when this occurs, when you stop?
Honestly, they may or may not. Markets work, as you know, work through expectations. So if markets foresee what we're going to do, then presumably, to some extent at least, what we're going to do should already be baked in. And it's very hard to predict markets' reactions to these things. But one of the reasons we're being so very transparent is that markets will incorporate the timing and the form of the taper that we're going to ultimately undertake here, because we will have sort of communicated it well in advance.
Thank you. Chairman, you said that one of the causes of inflation that consumers are experiencing is from supply bottlenecks. Some of these supply issues are being...
Bueno, pues eso, ¿habéis entendido algo? Yo tampoco. Que no, algo sí he entendido. Bueno, pues aquí el amigo dice que todavía queda mucho tiempo para una recuperación completa, que la inflación es puntual debido a que vuelven a abrir la economía, y bueno, pues los que preguntan estaban diciendo que no hay, que está subiendo, que la inflación afecta al petróleo, afecta a muchas cosas, ¿no? Entonces, bueno, pues le hace las preguntitas de siempre y pues la misma respuesta de siempre. que tiene como mandato estabilizar los precios, bla 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 bla. Y bueno, y no dice nada, como quien dice, ¿no? El mercado ya veis lo que lo ha hecho, no ha hecho nada. Como quien dice, ha caído y se ha recuperado y ya, pero sin grandes movimientos. Tampoco se esperaba que hubiese mucho movimiento hoy, así que nada. Y aquí en el oro pues estoy pilladísimo, ¿no? Me he metido aquí, pues mala idea, ¿no? Ya que era tarde, mala idea. Luego he tenido folla, me la he devuelto una vez, aquí está en menos 30, no la he querido cerrar, ha caído otra vez, he vuelto a tener folla, menos 50 o así, por ahí como ahora. Y bueno, la cosa es que tanto va el cántaro a la fuente que al final se rompe, ¿no? Y entonces eso, pues como iba muy largo el stop, le he movido el stop para aquí, debajo de una vela de 15, pero incluso podría cerrarla ya, ¿no? Y ahorrarme esos puntitos. Pero claro, ahora tiene aquí la media y ahora pues el precio puede apoyarse aquí, puede subir para arriba. Entonces bueno, ¿qué tengo que perder? 30 euros más, ¿cuánto pierdo aquí? 88. La cuestión es que dejo la cuenta por debajo del 20.400 y eso psicológicamente pues me raya un huevo, porque es como si no hubiera venido, como si no hubiera venido. Entonces pues bueno, la posible jugada, si me da tiempo ahora mientras me lo explica, no me salta en el stop, la posible jugada sería dejarla a ver si recupera el precio y cerrarla cerca de cero, ¿no? Pero parece que no va a ser así. Parecía que aquí venía, pero parece que no va a ser así y que bueno, me va a soltar el stop. Pero es que el anterior stop está a 160. Es el doble casi. Me he bañado un poco con el tamaño de la operación y bueno, está para cerrar 0.10, pero no lo he cerrado y bueno, ya sabes. Me he rayado entero con estas operaciones, de que tenían que haber salido esas caídas. Y pues al final no he ganado una mierda y pues nada, y pasar un mal rato, ¿no? Porque al final aquí si te salta un stop en el Nasdaq, pero en el Dow no me hubiera saltado y en el SP tampoco me hubiera saltado, ¿no? Entonces pues me toca un poco los cojones, un poco bastante, la verdad. Así que nada, me he metido ahí en el oro y bueno, pues esto que va a ser. Y bueno, por unos pocos, por 20 céntimos más la voy a dejar por aquí. Y quién sabe si esto va a ser una zona de suelo para quedarse así picoteando, igual sube a la noche o vete a saber. Igual hay alguna sorpresa así inesperada. Y bueno, pero el stop bueno está por aquí abajo. Si lo pondría a 100 euros por aquí abajo, estás esperando meter aquí para que suba por la noche y te levantes por la mañana con 200 o 300. Que bueno, es lo que explicaba antes, ¿no? Como ya ha roto la caja esta, el rango este, ya lo ha roto para arriba, entonces ahora ¿qué? Retroceso, rompe el rango, retroceso para hacer un soporte y seguir subiendo y romper el máximo. Esa era mi intención. Lo que pasa que sí que es cierto que es un poco tarde ya. Me he metido ahí a las 5:30, es tarde para meterte. Si eso igual mañana, pero vete a saber. Lo cojonudo también de esto es que bueno, me he metido 2 días al alza en el oro, uno stop, otro cero, y hoy que me podía haber metido, pues, y llevarme lo que quería yo, que era la rotura del rango, pues no me lo he llevado, pues porque no me he metido. Así que una puta mierda. Así que ahora estoy aquí, que me voy a marchar ya, porque ya aquí no hay nada que hacer, ya tengo el stop puesto y pierdo esto y a correr, y ya está. Y si quiero la cierro ahora y pierdo 50 nada más. Pero claro, si la cierro ahora y de repente se queda así y empieza a subir un poco y a la noche sube y mañana te levantas con, yo que sé, más 100, por no decir algo más, ahí está la movida. Pero bueno, esto es que esta línea de tendencia se va a romper seguramente para saltar todos estos stop, David, porque aquí está toda la peña comprada, ¿no? Teóricamente. Entonces pues no sería raro pues que saltarían el stop pues para luego irse para arriba. Entonces bueno, pues lo he dejado en un término intermedio, el stop, menos 88, pues menos 88. Mañana es el otro día y bueno, pues sigo lejos del objetivo. Con lo bien, no había empezado mal el día, pero la tarde pues me han jodido, pero bien. Estas dos y esta del Dow, que menos mal que he hecho estos defensivos en las dos, si no hubiera sido menos 200 más. Así que bueno, mal, pero podría haber sido peor, ¿no? Y bueno, la mala suerte del Nasdaq, que ha saltado esto por nada, por un par de puntos. Y si no, pues esto ya había aquí una diferencia, pues aquí han sido 100 euros, 38 a 100 euros, pues por 2, pues 200 y pico. Hay 300 pavos de diferencia ahí. Entre que salte el stop y sacarla por aquí. Eso ya te pone en 7,70. ¿Y el petróleo qué ha pasado? Que al final se ha pegado el piñazo, pues estaba claro. Lo que no sé es por qué no lo he metido aquí. Con esto, por 300. Si es que ya estaba. Ya estaba, igual que la semana pasada, ya estaba. Con la de Ethereum y con la otra. Así que nada, una puta mierda pinchada en un palo. Una mierda. Vamos a ver. Entonces, bueno, el stop este saltará seguramente y si no salta, por sorpresa, ¿no? ¿Qué voy a decir? Igual ahora salta ahora mientras se acaba el stream. Pues salta, pues saltará. Pues ¿qué se le va a hacer? Entonces, bueno, pues esa es la jugada, ¿no? Dejarla que salte el stop, si no yo lo miraré luego en el móvil a ver qué tal va, a ver si ha saltado, a ver si no ha saltado, a ver qué pasa. Si recupera a cero la puedo cerrar a cero y si no, pues no sé si la voy a dejar a la noche, si llega o no sé lo que voy a hacer. Lo que sí sé es que otro día que se ha pasado y aquí estoy y no llego a ganar 1000 pavos, macho. Hay que joderse. Y no será por falta de oportunidades. Así que, pues nada, voy a dejarlo ya por hoy y a ver si hay suerte y mañana nos vemos. ¿De acuerdo? Hasta mañana.